In today's video, we're going to be speaking about how technology stocks appear to be overvalued compared to their historical norms. In this first chart, I want to go deeper into technology versus everything. We'll go top down, technology versus the SPDR S&P 500 fund and the Invesco Equal Weight RSP fund. So if we look at the XLK position, which is the technology, so in our industry you commonly use a bucket of stocks to represent a sector. XLK is that bucket of stocks, and here is the stocks that are held within that bucket. You'll notice that Microsoft is 22.5% of the XLK, Apple is 21.12%, Broadcom, etc. This is comprised of 64 positions. And in our industry, that is considered a good representation of the technology sector. Next, we will take a look at the SPDR SPY, SPY, which is commonly referred to as the S&P 500 or the market. So SPY is comprised of 7.2% of Microsoft, 6.96% of Apple, 3.6% of NVIDIA, etc. You'll notice to the right-hand side over here again, the SPY is comprised of 503 different stocks. Typically, we refer to it as S&P 500, but there's 503 positions because positions come and go, so it's right around 500 at most times. Next, we will take a look at the RSP chart, which is called the Equal Weight S&P 500. Now, equal weight is considered to be more indicative of what the economy looks like, what the stock market looks like, because it's taking all of those same 503 stocks and giving them an equal weighting. So it starts out with 0.2% of each 500 stocks. If you add that up, of course, that would equal 100%. Here at the top, we've got Catalent, followed by AMD, Broadcom. These ones towards the top that show 0.25% obviously are greater than the initial starting 0.2%. That tells you that they have outperformed the others since the last time they, quote, rebalanced this. Again, down at the right-hand side, you'll see there's 503 stocks within this position, and they do rebalance that to 500 from time to time. So why are we not chasing these stocks? Let's look at it from a long-term viewpoint. So if you look at the XLK over time, let's look at some of the performance attributes. As we already showed in the first chart, XLK has a performance of 52.68% over 1 year time frame. Now if you start to look out further, you're seeing that there's a 3-year average of 16.23%. So if you've done 53%, let's call it in 1 year, we'll just round up to make these easy, but your average is 16% over 3 years, that means you've outperformed to the tune of 3.5 times. That's not when you're looking to buy stocks. If you recall the old adage, you buy low, you sell high. This would be the exact opposite of that thesis. We would absolutely be buying high. Could it go higher? Possibly. But in the end, everything returns to the mean. It would likely be buying high, selling low. So we're not doing that with your money. I'm not doing that with my money. In this final chart today, I want to explain to you what I mean by investments returning to their mean. This is not specific to XLK. It's every investment that exists. So if you look at this chart, you'll see the orange line here represents the 50-day price average. They take the last 50 days stock price of XLK and they average it out, plot it on a line. We also have the 200-day, which is the most commonly recognized long-term price average in our industry. Right now, it's trading at 205.53. If you figure that out, we're 30.5% above the long-term 5-year price average. Everything returns to the mean. If you look back historically, you'll see 2 other times here in 2022 and the end of 2019 when it did touch back to the mean. We would expect that to begin happening somewhere in the near term. It's really high right now, and we'll be waiting for a better opportunity to buy later. As you can see, investing has to be a long-term process, So that's why we're standing on the sidelines waiting for another opportunity to get into technology.